Well, most people are going to need a loan in order to buy their home since they don't have cash or some other place to borrow against, like a 401k or an insurance policy. So when you're making those phone calls to banks and other entities, know what questions to ask. Understand what makes you a strong buyer. Because when you agree to take on the debt of that home and to pay off that mortgage over 30 years, well, you're exactly what the investors are looking for. Hi, my name is Clarice, and I'm a full-time RE/MAX Platinum Realtor, and I'm from the area. Even though investors is a broad term, you may have investments that are funded with like a 401k, and if those funds have fixed income components, it's quite possible that a percentage of that fund is allocated to bonds that are backed by mortgages. In that sense, you're even part of the investor side of the equation. So the important part is that there's money out there looking for a home where it can generate a return for investors. Most mortgages, they become investments, like a government agency or enterprise, like Freddie Mac or Fannie Mae. They set certain standards for loans that it will insure, and the agency also provides a framework that mortgage companies can use to evaluate or underwrite your loan scenario. So if your scenario makes it through the hoops of the agencies, your eventual mortgage is going to become eligible for a certain pool of similarly eligible mortgages. Mortgages grouped together in this way, they're called mortgage-backed securities, or MBS. MBS, it carries guarantees from one of the agencies, Freddie Mac or Fannie Mae, which is going to protect the investor in the event that the mortgage borrower doesn't make payments for any reason. And they're going to ensure that they'll receive all the interest and principal that they would have otherwise received for as long as the underlying mortgage exists. When we have a high number of units or mortgages all meeting the same criteria, well, especially when those units are destined to be mixed together anyway, it's easy to establish a standard price at any given time based on the supply and demand. It's this price that has the most direct effect on what you're going to pay for your interest mortgage rate. Well, this going rate that big investors are paying for pools of mortgages, it's quite simple of a certain category of mortgage-backed securities. These are essentially bonds that are either an explicit or implicit guarantee from the U.S. government. That means that the MBS prices, they're going to move up and down with a high degree of correlation to the price of the government bonds of similar length of time. The catch is that the consumer's mortgages that are underlying the mortgage securities, they can be paid off at any time by selling your house or refinancing, foreclosure, or short sale. So they provide less predictable cash flow for investors than the U.S. Treasuries, which will keep paying the same amount throughout the lifespan. The implication is that the average lifespan of a pool of 30-year fixed mortgage ends up being more in the neighborhood of 6 to 11 years. Depending on the real estate market and if the rates drop, which causes a surge for the refinancing. Investors, they're not willing to pay so much for loans with cash flow uncertainty. Like if I have $100 to invest in treasuries or MBS, I'm going to expect a little slightly higher rate on the rate of the MBS, because if a fifth of the loan in that pool of the MBS, if they refi or sell, then I'm left collecting interest only on $80. Whereas if I bought the treasuries, I could be assured of a lower rate of interest for the entire term. Hey, I thank you for watching, and I appreciate if you hit that like button and leave a comment. Let me know what other areas that you'd like to hear more about. And always, please feel free to reach out and give me a call, text, or email. This brings us to the core concept of what drives mortgage rates. They tend to move a lot like the U.S. Treasuries of similar durations. When an investor loses in utter cash flow certainty, they gain in higher rate or return. If that rate of return looks like a good deal compared to treasuries, well, then the demand for the MBS, it increases, and the effective rate of the return, it falls, and vice versa. If the MBS lowers, well, then the treasuries increase. While it varies over time, the gap between a 10-year U.S. Treasury yield and the average top-tier 30-year fixed mortgage rate quote, it's maintained a range of 1.55 to 2% since September 2012. More than the other factor, this is the foundation of the first several percentage points of any mortgage interest rate. In other words, take the 10-year Treasury yield and add 1.5 to 2%. That's it. That's the baseline. From there is just fine-tuning based on variables pertaining to you and your lender. Lenders vary what they can offer you in terms of rates. This can be affected by the profit margins, the number of employees, advertising, legal costs, and other factors that affect the overall efficiency. So a lower rate, it doesn't necessarily mean it's a better deal. It's just a higher risk. that something unexpected happens during the course of your transaction. If there's a higher risk that something unexpected happens during the course of your transaction, plenty of mortgage seekers have had amazing experience paying a rock bottom rate to a highly efficient operation without getting a ton of one-on-one time with the loan officer. And plenty have had amazing experiences paying higher rates because it afforded a higher level of customer service. And to be sure, some companies are just better than others, as they represent a sweet spot that balances the many factors driving the final cost of the loan. It's equally true that some loan officers are better than others, even in the same company. There's several reasons why you might end up getting several quotes from different mortgage companies. During the process, just keep in mind that the mortgage company can only control the rates and fees that it charges. There's other fees as well, and some of them are more careful about under-promising and over-delivering on the affordability, and others will attempt to minimize the appearance of the third-party fees. You know, the stuff that you're going to pay no matter whom you choose for your loan, in order to give the appearance of a more competitive quote. And when it comes to hard numbers, the only basis for a direct comparison of one company's rate to another is the interest rate itself and the fees charged by the mortgage company itself. From there, it's up to you on how much that you value their trust and their customer service. Now you know what to think about and what to ask when you reach out for mortgage companies. Please feel free to reach out and stay safe.